Now let's discuss the treatment of special pool item. What elements can be added in special pool? So there are four types of item. One is called the long life assets. If you acquired any long life asset, then it's a part of a special pool item. Then a high emission car. The definition of high emission car is that its carbon dioxide emission rate is greater than 110 gram per kilometer. So if any car is being purchased with a CO2 of greater than 110 gram per kilometer, it would be a part of special pool item. And as we know that there is no AIA on any kind of car, whether it's high emission car, low emission car, or a standard emission car. Next is thermal insulation of a building. If any expenditure is being incurred on that, that is that will be part of a special pool item. And the last one is integral feature of building. As we know that land and building is not considered as plant and machinery for the purpose of capital allowance calculation, but if any item is being purchased which is an integral feature of building, such as, for example, heating system, it might be a cooling system, lifts, escalators, etc., etc. If these are considered as integral feature of building, so any item relates to integral feature of building will be part of special pool item. As far as the long life assets are concerned, two conditions has to be satisfied. The life will be greater than 25 years, and an expenditure of at least 100,000 pounds. That item then would be classified as a long life asset. So these are the list of the special pool items. Now let's take an example how to deal with special pool items in our calculation of capital allowances. So let's assume that we have tax written down value brought forward of a journal pool item, and that is given as 50,000. And now we have an addition of an item that is a heating system that is integral to a building, and that is costing us 2,80,000 pounds, plus we have purchased a car having a CO2 rate of 140 gram per kilometer, and that costing 100,000 pounds. Now calculate the capital allowances. So in this example, we have a journal pool item brought forward balance, and we have two new assets. One is a car, or other is a normal item, and both are a special pool item because heating system is an integral feature of building, and car CO2 is greater than 110 gram per kilometer. Now let's calculate the values. So we have first column journal pool, and then we have a special pool column, and afterwards the column of the capital allowance. So the opening balance, that is TWDV, brought forward is 50,000, and now we have addition. So as we know that the AIA is up to 200,000, and AIA is available on journal pool item as well as the special pool item too. So the heating system is available for the annual investment allowance, and we have 280,000 of investment, and AIA is available 200,000. So we have claimed AIA 200,000, and the surplus is now transferred to the special pool item. And then we have a car. Car balance is directly transferred to the special pool, because of the nature of the item. Now let's calculate the balancing figure. We have journal pool item 50,000, and now we have 180,000 value in our special pool item. So now let's calculate WDA. As we know that the journal pool item attracts a WDA of 18%. So let's work it out. So we have the capital allowance, written down allowance 9,000 on journal pool. But as far as the special pool is concerned, the WDA rate is only 8%. So now the rate is converted into 14,400. So this is 14,400. Now let's work out TWDV closing balances, and that is 41,000. And as far as the special pool balance is concerned, and that comes to 165,600. And now let's total out the value of, so this becomes 200,000 plus 14,400 plus 9,000, and that is 223,400, and that is total allowance. Now, one thing comes in the mind of the student, that if in any given question we have an asset that is related to a journal pool item and other that is related to a special pool item, and both can be used for AIA, then what is the order for claiming AIA? So let's discuss the order of AIA as far as the assets are concerned. It is always beneficial to use AIA for the special pool item first. We are talking about the beneficial way. Then you can use your AIA against the journal pool item, and then you can use your AIA against the short life election, which we are about to discuss, and then the private use asset. Why private use asset in the last? Because whatever we can claim against the private use asset, whether it's AIA, WDA, or whatever, we can only get the business part of allowance rather than the 100% allowance. Now let's discuss the short life assets or short life election. Sometimes it happens that the life of the asset or the benefit that you are deriving from the asset is very, very short in nature. So if it is the case that the life of the asset is up to 8 years, or you can say that you can consume asset within 8 years of its useful life, then we have an option available that either we can show the asset as a journal pool item or a special pool item, or you can say the pool item, but you can also elect it as a non-pool item, or you can use it like you can depool that asset. What it means? Depooling means that for a short life asset, you can make a separate column, as we did in for private use asset. So we can make a separate column for a short life asset. Remember that for a short life election, the life or the benefit will be within 8 years. If the life is more than 8 years, or the expectation is that the life will be more than 8 years, then you cannot claim short life election. So if you are trying to depool that item, that means that a separate column is being made, and the benefit of separate column is that in case of disposal, you can easily get your balancing allowance or balancing charge earlier than as we use in journal pool or a special pool item. So let's put into question first. uh, Assuming we have TWDV brought forward given for a journal pool item, that is 20,000, and similarly we have a short life asset in which we have 15,000 balance available. Now and it's assuming it's a computer. And assuming we have a disposal of that short life asset at a price of 8,000, and its original cost was say suppose 50,000. Calculate capital allowances. Here we have two columns. One is journal pool, or one other is a special short life column. And we have no addition in this question, just a disposal of short life asset. So let's see what is the answer. So the first column is a journal pool item. Second one is short life. Third one is a column of allowance. So we have TWDV brought forward, and that is 20,000, and short life asset is 15,000. Now let's put the value of the disposal. It is, as per the rule, lower of the original cost and the sale proceed. So it's 8,000. Now the remaining balance is 20,000, and here the balance is 7,000. As it's a positive balance, so you can claim it as a balancing allowance. For journal pool, the rate is 18% per annum. So that means we can claim a WDA of 3,600 on that. And as far as the short life item is concerned, so we can claim balancing allowance as 7,000. So this is the value of balancing allowance, and we have 1,0600 total allowance, and this is nil, and 20,000 minus 3,600, this will give you a figure of 16,400. So this is TWDV carried forward balance, and this is total allowance. Another rule that we are going to discuss is small pool WDA. Now, this rule says that if in any pool item, that is journal pool or a special pool, if after addition or disposal, the value is 1,000 or less than that for a 12-month period of account. Remember, this is for a standard 12-month period of account. That means that if the period of account is less than 12 months or it is more than 12 months, this 1,000 value will be proportionate accordingly. So if the short period of account is there, then the value will be less than 1,000. And if there is a long period of account, the value would be more than 1,000. So now exactly what is the rule? If after addition or disposal, the balance is 1,000 or less than that, then no need to apply a WDA of either 18% or 8%. Instead, you can claim the full value of WDA. So let's put it in a question. So we have like TWDV brought forward of a journal pool item, and it's 800. Now we have an addition of a plant that we have purchased in this year, costing us 1,80,000. Calculate capital allowances. So in this case, we have an addition, we have a journal pool. So let's solve this question. So there is only one column, as far as the item is concerned, and another is the allowance column. The opening balance is 800, and there is an addition of plant. So plant cost is 1 lakh 80,000. As you know that there is an AIA, so we can claim maximum AIA up to the cost, that is 180,000. I have transferred this 180,000 into allowance column. Now, there is no surplus left out, so the pool balance is only 800. And as we have discussed it as a small pool WDA is one where the balance is 1000 or less than that. So as the balance is less than 1000, so instead of WDA, we can claim it as a small pool WDA, or you can claim the 100% of the amount left out. So this is the case. Now we have the total allowance available is 180 and 800. So this is like an example of small pool WDA. Now lastly, we have the case of the last year of business, that is the year of cessation, when the business is being closed. So remember the rules that in the year of cessation, that is the closure of the business, there is no AIA. You cannot claim any AIA even if you have purchased any asset in the year of cessation. So no AIAs can be claimed. Similarly, no first year allowance for any car. Similarly, no WDA. Now you must be thinking about that if you are not getting any AIA, first year allowance, or WDA. So will you able to get any kind of capital allowance in the year of cessation? Yes, in the year of cessation, you can only claim a balancing allowance, or it might be a situation of a balancing charge. That depends on the balance, that is either it is a positive balance, then you can claim it as a balancing allowance, or if it's a negative balance, then you can claim it as a balancing charge. Let's put this into a question. Assuming we have a brought forward balance, and that is related to a journal pool item, and it's 50,000. Now we have an addition. We have purchased a plant costing 1,50,000, and then all the assets in the pool, have been sold, including the above plant, at a price of 1,20,000, and the selling price is lower than the cost. Now, how much capital allowance is available? We have to find out the value of capital allowance. Now, let me solve this question. So we have journal pool and allowance column. The opening balance is 50,000. Now in the normal situation, if because I have assumed in this question that it's a case of cessation of the business. Now if it was a normal situation, then on a purchase of plant 1,50,000 you will claim AIA. But as I am assuming a situation of cessation, so now there is no AIA, and the plant cost will be transferred to the pool directly. And we have a disposal of 1,20,000. So after addition and disposal, the value that is left over is 80,000. Now in the normal situation, we used to calculate WD of 18%, but in this case, as it's a positive balance, so this is to be claimed as balancing allowance. Now we have balancing allowance of 80,000 and our total allowance is now 80,000. So that means that in the year of cessation, no AIA, first year allowance, WDA, any kind of allowance is not available except for the balancing allowance or balancing charge.